Okay, so here's a trade review of a trade I took the other day. Here we have the 15-minute chart. Price takes out sell side liquidity right here. After price takes out sell side liquidity, you can see we trade above this down close candle, which becomes a bullish order block. When we have this, this is what ICT refers to as a change in the state of delivery. So right here, during all this price action, price is in a bearish delivery state, basically, meaning that it's delivering lower prices. Once we have this taking out the sell side liquidity and then going above this down closed candle for it to become an order block, now the algorithm is shifting to a bullish state of delivery, meaning that it's going to deliver higher prices. All you need for a change in the state of delivery is for price to close above the body. So you can see price doesn't close above the wick right here, but it does close above the body. Once it closes above the body, now we have a change in the state of delivery. So then we have the change in the state of delivery. We come back into it on this candle, go higher, change in the state of delivery. Then we come back into this down closed candle and then go higher. So after we go higher, after basically bouncing around in this order block, now we have another order block that forms. An order block within another order block is called a propulsion block. Propulsion blocks tend to act more strongly than order blocks in terms of when price hits them, there's usually energetic price run, or price likes to move fastly away from them if the context is right. So in this example, we're looking for higher prices after taking out sell side liquidity. When we hit the propulsion block, price should not waste any time here. It should go higher, as you can see. But that was just the initial framework of my trade. I saw sell side liquidity taken, and then I saw the change in the state of delivery. AM session starting right here at 8:30. We're bouncing around in this order block, and then we have this candle right here at 9:30, creating a propulsion block. Now, that's not enough for me to want to enter the trade. Within this order block, I want to see a fair value gap. The way I like to trade order blocks is if there's no fair value gap, it's not considered high probability to me. Now, it doesn't have to be a fair value gap on that chart per se. So like in this order block on the 15-minute chart, there's no fair value gap within that order block. But as you drop down to a lower time frame, which I'll show you in a minute, there is a fair value gap. And when I see that, that's when I like to use the order block. That's considered high probability to me. So dropping down to the 1-minute chart, we have sell side taken. We go higher right at 8:30. We're bouncing around in this order block. And at 9:30, we trade higher to form that 15-minute propulsion block. Now going back to what I said about high probability order blocks and propulsion blocks having a fair value gap, now you can see the fair value gaps within the order block. You can see it here when we traded higher and we had the change in state of delivery at 8:30, fair value gap within the order block. Propulsion block, fair value gap within the propulsion block. So now, once we hit the 15-minute propulsion block and the fair value gap on the 1-minute chart, I want to see a little more confirmation in price. And what I mean by that is a shift in market structure to the bullish side. A shift in market structure is basically when you take out an intermediate term high, and one form of that is a swing high inside of a fair value gap. So we have this swing high right here, which is inside this fair value gap. And by inside, I mean the body of the candle doesn't close outside the fair value gap. So once we have the shift in market structure, in that price run that creates the shift in market structure, is there a fair value gap that forms? Yes, there is. So when price came back to that fair value gap, I entered, which is the blue candle right here. And my target was a standard deviation measuring from this high to this low. The first standard deviation that is above this buy side liquidity, which is this level right here. And you can see the red arrow is where I got out at as soon as we hit the target level. Now, these red and blue arrows are made by TradingView through your broker. I can't put these arrows on the chart. So I'm not making this up. There's no way that I can fake it. This is a trade that I actually took. And I wanted to review this trade to show you guys the logic behind why I like to take certain setups and why I don't like to take certain setups. Not every fair value gap is a fair value gap that you want to trade. Not every shift in market structure is a true shift in market structure. You got to have a little bit more context behind why you can trust that shift in market structure, why you can trust that fair value gap, or any other key level that you want to trade. But with all that being said, I hope that this trade review was meaningful to you guys, and I will be doing these hopefully around twice a week, maybe once a week, but I will be doing these weekly for you guys to help you guys better understand ICT concepts, because I know that there's a lot that he talks about, and it can get confusing and overwhelming with all the information that he throws at you guys. So I've been learning his content for about 3 years now, and I feel like I am able to teach it in a way where it is more digestible and easier for the consumer. I'm not saying that I'm a better trader than ICT, but I think I'm able to teach his ways, teach his concepts in a way that is more relatable to a beginner. But with all that being said, I hope everyone has a wonderful and blessed day. Thank you for watching.